Have you ever sat at your desk staring at the clock and wondered, is this it? Am I going to be doing this for the next 30 years? It's a thought many of us have. We trade our precious time for a salary. But what if there was another way? What if you could build a system that pays you, whether you're working, sleeping, or on vacation? This isn't a fantasy. It's the power of investing, and today we're going to talk about a simple yet powerful tool that could help you achieve this. The ETF. Now, I know what you might be thinking. Investing sounds complicated, or I don't have a lot of money to start. I get it, but I'm here to show you that it doesn't have to be that way. We're going to break it down into easy-to-understand steps. So what is an ETF? Imagine a basket of chocolates. Instead of buying just one type of chocolate, you buy a basket that has a variety of them. An ETF or exchange-traded fund is like that basket. But instead of chocolates, it holds a collection of stocks or bonds. When you buy a share of an ETF, you're buying a small piece of all the companies in that basket. This makes investing simple and less risky than picking individual stocks. Today we're going to explore a fascinating idea. Can a simple portfolio of just 4 ETFs potentially replace your salary? We'll follow the story of a woman named Maya, who asked herself that very same question. Meet Maya. Maya is a 30-year-old graphic designer. She's creative, hardworking, and good at her job. She earns a decent salary of $50,000 a year. But Maya dreams of having more freedom and flexibility. She wants to travel, spend more time with her family, and maybe even start her own small business one day. But her salary, after taxes and living expenses, doesn't leave much room for her dreams. She felt stuck, like she was on a treadmill, running hard but not getting anywhere. One evening, after a particularly long day at work, Maya decided to take control of her financial future. She didn't have a background in finance, but she was a quick learner. She started reading books, watching videos, and learning about different ways to make her money work for her. That's when she discovered the world of ETFs. The idea of owning a small piece of hundreds of companies with a single investment appealed to her. It felt safe and simple. Maya decided to create a plan. She wanted to build an investment portfolio that could one day generate enough income to cover her living expenses, effectively replacing her salary. She called it her Freedom Fund. She chose a 4 ETF strategy. Each ETF had a specific role to play in her plan. Let's take a look at the 4 ETFs Maya chose for her Freedom Fund. The 4 ETFs for Financial Freedom 1. The Growth Engine. Vanguard Total Stock Market ETF, VTI. The first ETF Maya chose was the Vanguard Total Stock Market ETF, or VTI. Think of this as the engine of her portfolio. VTI invests in the entire U.S. stock market, from big, well-known companies like Apple and Microsoft to smaller, up-and-coming businesses. By buying VTI, Maya became a part owner of thousands of U.S. companies. This gave her broad exposure to the growth of the American economy. When the stock market does well, the value of her VTI shares goes up. Maya decided to allocate 40% of her investment to VTI. She knew that the stock market could be volatile in the short term, but over the long run, it has historically provided strong returns. This was her long-term growth play. 2. The Income Generator. Vanguard High Dividend Yield ETF, VYM. Next, Maya wanted an ETF that would pay her to own it. That's where the Vanguard High Dividend Yield ETF, or VYM, came in. This ETF focuses on companies that are known for paying out a portion of their profits to shareholders in the form of dividends. Think of dividends as a thank you gift from the companies you invest in. They are regular cash payments that you receive just for holding the ETF. VYM invests in large, stable companies like Johnson & Johnson and JP Morgan Chase. These are companies that have a long history of paying dividends. Maya allocated 30% of her portfolio to VYM. The dividends she received from VYM would be like a small second income stream. And the best part? She could reinvest those dividends to buy more shares of the ETF, which would then generate even more dividends. This is the power of compounding, the stabilizer. Vanguard Total Bond Market, ETF, BND. Maya knew that investing only in stocks could be risky. The stock market can have its ups and downs. To balance out her portfolio, she needed something more stable. That's why she chose the Vanguard Total Bond Market, ETF, or BND. Bonds are essentially loans that you give to governments or corporations. In return, they pay you interest over a set period of time. Bonds are generally considered safer than stocks, and they provide a steady stream of income. BND invests in thousands of different U.S. government and corporate bonds. When the stock market is down, the bond market often holds its value or even goes up. This helps to cushion the blow and reduce the overall risk of her portfolio. Maya allocated 20% of her investment to BND. This was her safety net, the part of her portfolio that would provide stability and peace of mind during turbulent times. 4. The real asset, Vanguard Real Estate ETF, VNQ. Finally, Maya wanted to invest in something tangible, something she could see and understand. That's where the Vanguard Real Estate ETF, or VNQ, came in. This ETF invests in companies that own and operate real estate, such as shopping malls, office buildings, and apartment complexes. This gave Maya exposure to the real estate market without having to buy a physical property. Real estate can be a great investment because it generates rental income and has the potential to appreciate in value over time. Maya allocated the remaining 10% of her portfolio to VNQ. This added another layer of diversification to her Freedom Fund and another source of potential income. Maya's journey. So, Maya had her 4 ETF plan. She started with an initial investment of $10,000 that she had saved up, and she committed to investing $500 every month no matter what. She set up an automatic investment plan so that the money was transferred from her bank account to her investment account every month without her having to think about it. In the beginning, the progress was slow. Her portfolio grew, but it wasn't life-changing. There were months when the market went down and she saw the value of her investments drop. It was tempting to panic and sell. But Maya remembered her long-term goal. She stuck to her plan, kept investing every month, and trusted the process. Years went by. Maya continued to live her life, work at her job, and build her Freedom Fund on the side. She got married, had a child, and her dreams grew bigger. Let's fast forward 15 years. Maya is now 45 years old. Let's see how her Freedom Fund has grown. Assuming an average annual return of 8%, which is a reasonable long-term average for a diversified portfolio like hers, her initial $10,000 investment and her $500 monthly contributions would have grown to over $200,000. But here's where it gets really exciting. Her portfolio is now generating a significant amount of income through dividends and interest. Let's say her portfolio has an average dividend yield of 3%. That means she's earning about $6,000 a year in passive income from her investments. That's an extra $500 a month that she's earning without having to work for it. It's not enough to replace her salary yet, but it's a significant amount of money. It could cover her car payment, her utility bills, or a family vacation. But Maya is not done yet. She's still a long way from retirement. She continues to invest, and the power of compounding continues to work its magic. Let's fast forward another 15 years. Maya is now 60 years old. She has been investing consistently for 30 years. Her portfolio, with the same contributions and an 8% average annual return, would now be worth over $750,000. And the income it's generating? With a 3% dividend yield, she's now earning over $22,500 a year in passive income. That's almost half of her original salary. At this point, Maya has options. She could choose to work part-time, start her own business, or even retire early. She has built a financial cushion that gives her freedom and flexibility. Conclusion. So can 4 ETFs replace your salary? As you can see from Maya's story, it's not a get-rich-quick scheme. It takes time, discipline, and patience. But it is possible. The 4 ETF strategy we discussed today is just one example. There are many different ETFs out there, and you can create a portfolio that is tailored to your own goals and risk tolerance. The key is to start early, be consistent, and stay invested for the long term. The sooner you start, the more time your money has to grow. If you're feeling inspired by Maya's story, I encourage you to take the first step. Start learning about investing. Read books, watch videos, and talk to a financial advisor. You have the power to take control of your financial future. You have the power to build your own Freedom Fund. And it all starts with a single step. Thank you so much for watching. If you enjoyed this video and want to learn more, make sure to hit that like button, subscribe to the channel, and ring the notification bell.